gate. They came to power by inspiring people to trust them with their money. And so the ability to understand the mechanics of money and banking is where the power lies, regardless of where you're starting from. So what exactly is a shadow bank? Shadow banks are like other banks, except they are non-depository institutions, meaning that you don't open a checking account with them. But every substantial financial transaction can otherwise be handled through the shadow banking system. And so a couple of examples would be investment banks, hedge funds, and other financial products and vehicles. And so again, the purpose of this presentation is to show you how to compliantly operate in this space and achieve institutional status. So who's this for? The topics are can be kind of technical, and a lot of people can sort of misconstrue that this may not be for me. In short, this is really for everybody who wants money, right? So no matter what your individual interests or expertise are, there's a role for you to carve out a space to get to this institutional scale of 9 figures and beyond. And so to start, I think the place where most people are introduced into finance and shadow banking is through syndications, commonly real estate people raising money for deals on an individual basis. And there are a few key ideas that differentiate syndicators from financial institutions, such as hedge funds and private equity funds and investment banks. First of all, syndicators typically try to sell a picture of the future that's largely based upon fiction. It's got no sort of, or very little reason to justify that expectation is going to be achieved. Whereas financial institutions look backwards in time, not forward. So they will perform a statistical analysis over the track record, over historical performance, to communicate the merits of what they're selling, at least internally, and even if that's not communicated through their retail or sales channels. So one of the key considerations is it starts with a looking backwards as opposed to trying to predict the future. And of course, there are several other considerations I really don't have time to dive into, but the crux or the conclusion really is that syndicators are chasing investors. Do you like me? Do you like my deal? Whereas financial institutions sell sought after financial products. And so I want to set clear expectations for what we're trying to accomplish here with this presentation. The first is that the only way to achieve complete financial independence is to possess the ability to create and control unlimited capital. Otherwise, you're always going to be subject to somebody else who has more or knows more. And then secondly, the only way to acquire that ability is through the closely guarded secrets of the shadow banking system that we're going to discuss today. So just a quick snapshot of me. This is basically a summary of my resume. I've been founded Adagio Group in 2005. We've run a series of funds, and we evolved into an investment bank. Also have an adjunct public charity dedicated to financial education to sort of help democratize access to this sort of exclusive insight that the institutions usually use to bet against the public. The purpose of the public charity is to bring that expertise to the public to level the playing field. And then before getting into finance, I played baseball professionally with the Padres organization, played football and baseball in college. My academic background is in physics, studied music as a second discipline. And then from a regulatory perspective, I've got a Series 65 license and a Florida real estate license. So you'll notice we're not a broker-dealer. We utilize third parties for the broker-dealer function, but that doesn't change the fact that we operate with the investment banking, as an investment bank, with the investment banking function.
Hey, Ben, I just want to take a minute. This is Danielle here. I just want to take a minute to say that the presenter notes are still up, and so that your slide's just looking a little small. I want to make sure people are able to see that.
I appreciate that heads up.
No
it looks
problem.
like the wrong screen is being shared. Let me reset that real quick.
Okay. I didn't know you played professional baseball.
I did. That really defined who I was for a very long time.
That's right.
And it was quite an effort, actually, to refine that sort of motivation to get up in the morning and to really make something happen. So
Amazing.
let's see if this doesn't help the situation a little bit. Can you see the right screen now?
Looks great to me. Awesome. Thank you.
All right. Yeah. Sorry about that. So anyway, yeah, and this is probably a good slide to switch over there, because this is basically the FINRA IARD system that houses our licensing and sort of demonstrates sort of the public disclosure and access to look up information about the financial services entities within Adagio Group, and effectively the timeline of our evolution. So like I mentioned, we founded Adagio Group in 2005, managed our fundamental fund was, our primary fund was Residential Income Arbitrage Fund through 2015, and then evolved into a boutique investment bank after that. And as an investment bank, our particular focus is on creating better risk-adjusted performance by securitizing alternative asset managers who can generate better risk-adjusted performance than what's otherwise available through traditional markets. And again, the core business there is to take emerging and startup asset managers who have the potential to do well and provide them access to the capital that they need to fulfill their strategy at its potential, which is typically 9 figures and beyond. And so typically for us to do that, that's a 7-figure proposition. And this, again, presentation, the intent is to cover and go over all the mechanics that are employed to get there, so that, and hopefully that you can take this in addition to a little bit of independent research and get there on your own. And I published a book on the subject. So The Shadow Banker's Secrets, Investment Banking for Alternatives, sort of a culmination of that experience. Quick stop for legal disclosures, right? So long story short, this presentation doesn't represent legal advice, investment advice, or tax advice. And anytime you're engaged in a highly regulated environment, it's important to retain your own professionals for guidance in that regard. So the presentation, the crux is broken down into 3 shadow banker's secrets. The first one is the investment bank, the secret investment skill that made top shadow banks over 20% during the 2008 financial crisis and every year since. The second is the shadow banking secret to create capital out of thin air and become your own bank. And the third, the shadow banking secret to save you from unknowingly breaking the law as you raise money for your investment portfolio or business. And I can tell you, it doesn't matter how much experience you've got or how much AUM you have, most sort of hardcore financial firms are breaking some sort of regulatory or securities issuance rule as they raise money, and the penalty is draconian. So the first idea, right? The first sort of secret. How do you generate substantial performance, and how do you communicate it? What does it even mean, right? So it all starts with this one fundamental question: what does risk actually mean? Risk is a number. It's the probability of loss weighted by the potential degree of that loss. Risk is not a feeling, it's not a relationship, and it's not a story. It's a number to be calculated. And with a fairly complex set of mathematics, the risk-adjusted performance measures do just that, right? And so when most people talk about investing, they have no problem talking about return as a number. I need X number of percent, 5% of my money, 10% of my money. They have no problem talking about liquidity as a percentage or a number. I need my money back in 6 years or 1 year or 6 months, whatever, right? But when it comes to risk, which is the most important variable, the one variable that differentiates investing from gambling, the conversation immediately deteriorates into storytelling. And that's kind of by design, right? It allows the big banks with the people who understand this stuff to structure investments to effectively bet against the public, and their army of sales staff called financial advisors are sort of left out of the loop here. Again, on purpose, right? It's just like a car salesman. If you sell BMW, you work at a BMW lot, you're indoctrinated that BMW is the best, and you're told exactly what you need to know to enthusiastically sell BMW. Financial advisors operate under the same paradigm, just with a little bit better licensing and vernacular. And so when it comes to risk measures, it's one thing to utilize the risk calculations to measure investment performance during normal times. And we'll say 2013 through 2019 might be normal times, which it's not, but that's a different conversation. But what's more important is the tail risk, or what happens, the catastrophic events that occur less frequently, like financial crises. So the last one in 2008, if you don't count what we're in right now, we saw equities markets lose about over half their value, and the real estate market lose over 25% of its value, which doesn't seem as bad in absolute terms, but on a relative basis, it's terrible because most people levered up with, like at that time, 90% plus mortgages, which means everyone was underwater, and that's sort of one of the catalysts for the financial crisis that we saw. And they happen to occur every 10 years, despite how people think, right? Like everybody's like, oh, I did great for the last 6 months. It doesn't matter, right? Because people tend to have a longer than a 10-year horizon. It doesn't matter how rich you are if at the end of every 10 years, you're going to lose it all, right? So it's very important when you're developing an investment strategy to not only design a strategy that operates well during normal times, but it's also properly positioned when these inevitable market crises that tend to occur in more significant magnitude with each iteration come to bear. And so we can start to dive into the risk-adjusted performance metrics here a little bit. A lot of people, particularly even in the retail space, are aware of beta and alpha and the capital asset pricing model. Those are all mentioned in the retail financial advisor exams, even though you don't dive into the mathematics with them. But these things start to tell you at least a fair amount about risk in terms of how prices change, average. From a statistical perspective, these are the first two statistical moments of risk. Let me back up a step and just say the most common metrics are listed here. There are more metrics that are required to give you a more complete picture. But the idea of risk as a number can be sort of intuitively communicated through the flip of a coin, right? And so if I told you I would give you $2 if you accurately predicted a coin flip, what would be a fair bet? And most people sort of intuitively know that if I bet $1 on a coin flip and get 2, that's fair. So if I told you I'd give you more, that would be a good bet. If I told you I'd give you less, it wouldn't be. And there's mathematics behind that. And this happens to be the most simple example of the math. And it works out as is sort of demonstrated in this slide. If you were to bet $1 and the chance of winning is 50%, you take the amount you're going to bet or invest, you divide it by the probability of the positive outcome occurring, in this case, 50%. And that tells you what the fair price of the investment would be, or what the fair bet would be. So in this case, $1 divided by 50% is $2. So when it comes, a slightly sort of more complex, but not terribly complex example is the case of a lottery ticket, right? So without diving into the math, it's similar to the flip of a coin, but suffice it to say that in the old school Powerball, the way that was constructed, the average jackpot warranted that a lottery ticket should cost 14 cents to be fair. But lottery tickets cost $1, which means the lottery corporation profited 86 cents on average for every dollar gross profit that was spent on buying lottery tickets. And that's not a bad proposition. So again, you can start to see this idea of investing in gambling and measuring risk-adjusted performance and its importance in determining how and what to invest. And here's a great example of why the lottery ticket's a bad deal. It's a 14-cent bet on a good day, right? And everybody's paying $1. It's gross. You're paying 6 times more than you should. So those are the basic idea. That's the basic idea around the probability of outcome. But there are more issues to take into account. And specifically, from a statistical perspective, from a technical perspective, these are called skewness and kurtosis. They're the third and fourth order of statistical orders. And the example of a soldier, the military, is a really good one to highlight this, right? So if you're just looking at the probability of an outcome, that tells you something. If I go to war or if I enlist in the military, the chance of me dying is very small, right? We're not at war often enough. the chance of being deployed into a hot zone are relatively small. The chance of being killed are relatively small. So the chances of winning and winning in the military is collecting your salary and coming out uninjured, right? The chances of winning are very, very good. But the problem is that if you don't win, the losses are absolutely catastrophic. You die, right? So the downside is infinite, but the upside is capped at a modest salary. So even though the chances of success are good, the relationship between the downside and the upside are terrible, right? So it's a very noble pursuit, but from a risk perspective, it's a terrible idea. So when you're investing, you want to flip that script, meaning that you want to structure investments where the downside is very small under the worst case scenario, and the upside is potentially unlimited. And one example that allows you to do that, if it's structured properly and utilized properly, is an option, right? Your downside is a loss of the option fee, which is relatively small, and the upside is potentially infinite. Now, an option in and of itself is useless. It's how do you use it properly with the right asset class, structured with the right terms to make it valuable. But that structure is a vehicle that allows you to take advantage of this sort of asymmetry between the upside and the downside. And then the fourth statistical moment is kurtosis, tail risk. Basically, what that means is these low probability events, and it's related to the soldier's bad bet. These low probability events, how often do they actually occur, and how do we measure that? And if they do occur, how catastrophic is that? So again, the banking industry lost more money in 2008 than it made over the previous 2 millennia, right? So what good does it do you if you're going to work your entire life to accumulate something if you know you're inevitably going to lose it all or maybe more, right? And so this is why it's important, even though the human mind is not conditioned to value it because of the sort of low frequency of its occurrence. So all the math is pretty complicated. One thing that we did is I developed a risk rating matrix that took the most informative risk-adjusted performance metrics and built them into a 9-box matrix to clearly and sort of cleanly communicate the value of any investment. Now, for the more technically oriented people, maybe some, if there are any quants out there, the measures that are taken into account are our maximum drawdown, which tells you how much you potentially lose under any scenario, the Modigliani measure, the omega ratio, and expected return. It's important to note that for any of these measures to have any value at all, the data to be measured has to encompass at least a minimum of 1 complete market cycle. If you don't have a data across a minimum of 1 market cycle, which today looks back at least to 2007, then you have 0 idea about how you're going to perform during the down times. 0, which means you really know nothing about your risk exposure. And again, that's the most important facet of investing. Now, you can't know everything. So like Nassim Taleb talks about in The Black Swan, in his Inserto, that there is a black swan by definition is something that has never happened before and you can't predict. But you can closely approximate what that might look like, again, by looking at what happened in the most recent downturn. So in addition to just the statistical analysis of risk, there's another sort of a very important consideration of financial risk, inflation, right? So U.S. Treasuries are fine as zero risk investments, right? That's the sort of the line of FINRA and the government. And so the reason they say that is because the United States is never expected to default on any debt payment. Well, the reason they don't default is because when they don't have the money to pay, they print it through the Federal Reserve System. So instead of paying less money than it's owed, they create additional money to make up the shortfall. Well, what does that do? When you create more money, chasing the same amount of goods and services, the value of that money goes down. So if you look here, as of January this year, 10-year treasuries, right, which is the common benchmark for zero risk, yielded under 2%. Well, inflation, the inflation rate was 2.5%, which means that the value of your money is diminishing at a greater rate than the growth of your money from a treasury, meaning it's a loss. So you can say all you want, treasuries have no risk, but is it really a risk if you're actually losing purchasing power in real time? So, I mean, anyway, the answer is yes. So, of how we took all of this sort of insight and applied it in a practical way. Because I could talk about these sort of abstract academic ideas till I'm blue in the face, and it doesn't mean anything if it can't be applied. And so we did apply it. And the way we applied it was by looking at the relationship in real estate, particularly in residential real estate, between income, rental income, and comparable sales values. And you could see around 1999 that comparable sales values started growing exponentially. It created a literal bubble. There's the picture of a financial bubble, whereas the income just tracked in a straight line, as it always had. And so what we did is we structured effectively a quasi-lending strategy based upon a multiple of the income as opposed to a percentage of the comparable sales value. So what that allowed us to do is it allowed us to bet against all the people who are like, hey, I believe real estate's going up, and I'm going to put my money where my mouth is because it's going to go up forever. And we said, all right, fine. You take that position, we'll take the other position. And we won. Because if they paid their debt, because we were offering effectively bridge loans, we were getting double-digit returns. And if they defaulted, we had a huge equity cushion. We were also getting double-digit returns. And so what that looks like, quantitatively speaking, is that the average return of this real estate fund between 2007 and 2015 was almost 30%. But even more importantly than the average return was the fact that there was no downside ever, even from 2008 to 2010. 32% returns in 2008, 41.5% in 2009. And it's not just magic. It's by understanding the mathematical relationship between the fundamental variables that dictate what make an investment perform. And so that's basically it, right? For step one, secret one, is you have to measure risk to have any idea what the hell an investment is in terms of its quality. The only thing that matters in investing is risk, return, and liquidity, with risk being the most important. So you better damn well measure it, right? And then once you can measure it, then you design your strategy in a way that minimizes the risk as measured and maximize the returns at the same time. And I gave you one example of what we did in real estate, but we're asset class agnostic. Like you can do it as a hedge fund with equities. It's harder because it's an efficient market. Private equity with buying businesses with the LBO strategy. The asset class does not matter. What matters is, does your strategy protect yourself from the downside? And you can almost bet your life that if it protects yourself from the downside, then the upside will take care of itself. Like, I'm not a big fan of Warren Buffett, but if you talk to like the Ray Buffetts, the Warren Buffetts of the world, and Ray Dalios, then that's really the thesis that drives everything they do. Plan for the worst and hope for the best. Plan for the worst. Don't just think about it, right? And so now we can start to dive into the actual securitization, the second secret, which is to create capital out of thin air and become your own bank. Now, a lot of people know about creating a private fund, and I'm so sick of hearing, PPM. Well, that's a legal document. That has no value, other than the legal work itself, right? And that's just the legal work. But when you have the power of a superior strategy that can be compared apples to apples against any other investment in the market, from stocks, bonds, real estate, mutual funds, other hedge funds, whatever, when you have demonstrably better performance, now all of a sudden the power of the private fund becomes infinite, right? And so the private fund structure allows you to minimize your regulatory burden while compliantly taking in unlimited capital from other people, right? So just a statistic about sort of the health of the American population from a financial perspective, almost no one has hardly any retirement savings. And so this sort of securitization skill can solve all facets of this problem. If you are an investment manager, an asset manager who has a good strategy, you can create a fund to aggregate capital and give the people who do have money the low risk yield that they need, that they can't get through their traditional financial advisor. If you don't have a strategy, but you can build relationships, then you can create a private fund that's a fund of funds that aggregates capital and simply invests in other asset managers who have quality risk-adjusted performance. Again, assuming it's better than what's otherwise available. Now, a quick caveat there. In addition to having the legal documents drafted, it's important that your numbers are verified. And two things that are typically utilized to verify the numbers are third-party administration and annual audits, which I'm adamant that every serious fund manager needs to employ, so that those numbers actually have meaning and can inspire trust. So just real quick, capital structure. I think most people are aware of this. Like the two common tranches of capital structure are debt and equity. As investors, retail investors or otherwise, people are typically looking for growth via equity or income via debt/fixed income. And so it's important to be aware of that in designing your capital structure for your fund. And then the capital markets are where these things are traded. So financial advisors selling financial products is an example of the expression of capital markets, exchanges, et cetera, right? Now, a sample portfolio to give you an idea about what you're up against when you're creating a private fund, right? The average return for the conservative portfolio that most every financial advisor is going to peddle is close to 6%. The aggressive growth is less than 10%. But look at the downside. So your average upside is under 6, but the most conservative scenario, you're going to lose almost 20% of your portfolio. If you try to get aggressive growth, which isn't that much better, you're going to lose over half. The point of this slide is that relative to traditional markets, the bar for risk-adjusted performance is very low. And arbitrage opportunities in private markets, like real estate, like private businesses, create extraordinary opportunity that equities and mutual funds don't. And so, again, this is private investment companies. Three common types are hedge funds, private equity, and venture capital. I don't think we necessarily have time to dive into the details of that. And then I mentioned fund of funds, right? Which is if you don't have your own strategy, you can create a private investment company that is designed simply to provide capital to those who do have a strategy worth allocating to. And you get compensated by providing people access to this performance that they would otherwise have no way of getting to. And then the documents for private funds, a lot of people are already aware of, which is the offering memorandum or private placement memorandum, the operating agreement, and then the subscription agreement, of course. And then the marketing materials are the 2-pager and the deck. And a lot of people think, if I check these boxes, I'm good. No, they're just the boxes. Don't be a technocrat. Technocrats lose, right? You win because you generate better performance or you provide access to better performance. These documents are just the conduit, right? The substance of what you do is where the value is derived. And so that's the second facet, right? Is the securitization of your strategy or the securitization of your access to performance via a fund of funds, right? So that securitization, and when I say securitization, a lot of people think just publicly traded. Securitization can be the formation of public securities or private securities. We're talking about private in this case, so it doesn't really matter. But utilizing that insight, the ability to create private funds, is the conduit, the vehicle to create the capital, literally create the capital. Those documents are capital. Dollars are exchanged for paper that you created. You created paper, you gave people paper, they gave you millions and millions of dollars based upon an idea and paper. It's literal creation of capital. Now, the third part, which is hugely important, is the compliance component, right? So we can create the strategy, we can securitize it under a private fund, but you have to be compliant or things can go very badly. And Woodbridge Wealth, I think I mentioned briefly earlier that there are several big asset managers, particularly in the real estate space. Real estate people typically don't know anything about finance, and finance people typically don't know anything about real estate, and it just creates a disaster. And this is one example. Woodbridge had raised like $1 billion. They were very arrogant in what they were doing. They had a legal opinion supporting what they were doing from an incompetent securities attorney. And the next thing you know, after 10 years plus, they're wiped out because of illegal securities issuance that ultimately led to other issues. And they're not alone. I can list a handful of them that have all gone down the same road. So if you are not in finance and you're issuing securities,
Ben is still in.
I'm just finishing up. Yeah. So anyway, if you are in alternative finance and don't have a background in securities law, then it is prudent to take on counsel who knows what the hell's going on that front. So this is a list of a few commonly ignored securities law considerations. Debt is a security. You can sort of quickly glance through these. I think the big takeaway here is that most securities attorneys are incompetent. And if you ask 5 different securities attorneys to give you an opinion on a complex matter, you're gonna get 5 different opinions. And so it's very important to find a quality securities attorney to provide counsel, but most are not very good. So it's going to take a little bit of exploration to make sure you're finding the right people on that front. Last sort of point here is investment clubs. One of the few areas where the SEC has provided clear guidance that about securities is interests in investment clubs that are structured properly are not deemed to be securities. Therefore, if you're administering an investment club, you are not subject to any securities regulation, which provides everyone the ability to aggregate capital without having to worry about compliance issues, as long as you don't commit fraud, right? And a sort of a low regulatory environment, right? So you can advertise to get people to bring in capital together who are not accredited, such that this one investment club becomes a accredited investor or a qualified purchaser that provides compliant access to exclusive private funds, hedge funds that you would otherwise not have access to. And so, again, the third idea is it's important to be compliant and utilize discretion when seeking legal counsel. So in summary, the three secrets: number one, measure risk-adjusted performance to manage your investment portfolio to better performance than what's available anywhere else. Create a fund that allows others to participate in your investment portfolio's performance in ways that meet their individual investment goals. And then third, legally issue shares in your fund without fear of the regulators and profit from hundreds of millions of dollars in your portfolio. And the hundreds of millions of dollars comes by virtue of simply having better performance than what's otherwise available and communicating it in straightforward terms in a compliant way. There's a $20 trillion demand for real yield and fixed income unmet. Not that hard to do it, to generate that, as long as you sort of stick by this process. And then as I mentioned before, we're an investment bank. The services that go into what we do are complex, and they are sort of many in nature. And so we can break those things out to serve any role in the market, from financial advisors to retail investors and asset managers. And so, yeah, that's very compressed. I appreciate you hanging in there for that. And if you've got any questions, I think we're going to have a Q&A on Discord after the fact.
That's right. Thank you so much, Ben. I know you compressed 3 hours worth of information into 30 minutes, so truly appreciate that. So yes, everyone, Ben is going to be on Discord doing an AMA or an Ask Me Anything session. That will be in the AMA room on Discord, so find him there. 10-15 minutes or so. And so, yes, now we have our next keynote speaker, Dr. Tausif Malik. So I'm going to switch over screen and introduce Tausif. See y'all there.
CSC Leasing Company has been offering non-dilutive equipment financing for more than 35 years. CSC's financing is non-recourse and does not require warrants, covenants, or giving up any equity in your business. As an alternative source of funding, CSC has financed nearly $1 billion in transactions while providing quicker and simpler transactions than traditional sources of debt. CSC works across all markets, from pre-revenue startups to middle market to large enterprise, as well as a wide variety of industries, and prides itself on saying yes when others tell you no. By financing your equipment instead of paying one lump sum up front, you can spread out your payments and have a predictable, fixed monthly payment that costs less than traditional lenders. With CSC's non-dilutive equipment financing, you stay on the cutting edge by accelerating technology refreshes without costly obsolescence or the hassle of equipment disposal. Explore CSC's solutions at cscleasing.com.